From founders to scale, a journey in venture building. In this episode, Dr. Jemma Green is joined by Evan Caron. We delve deep into the process of finding and nurturing climate-focused entrepreneurs at Montauk Climate. Learn how they recruit top talent, manage risk, and ensure ventures are built for scale despite tight capital markets. Discover strategies for balancing innovation with practicality in today's evolving economic landscape. I'm your co-host Anthony Pearl, and whether you're an investor or a startup looking for insights, it's time to get unblocked.
How do you go about finding the founders? Because most VCs are busy finding companies, but you've got the insights already, probably got more than you need. Then you've got to actually do the matching, the dating agency for the idea and the founders. How do you find them?
We spend a lot of time on calls, a lot of time mining our networks. We've used third-party recruiters to our advantage because there's a lot of people always looking for jobs. I think one of Philip's insights, Philip's our co-founder, his insights was there are a lot of very good operators that have not been in climate and not in the and what I mean by climate is anything on our side of the world: energy, climate, infrastructure, decarbonization, energy transition. They're not scientists. They're not subject matter experts in the field of circular economy or sustainability or ag tech, whatever, but they've helped scale up other businesses, and they have some domain expertise that would have an overlap. And so we spend a lot of time on the recruiting side talking to people who want to do something in climate, but are not comfortable taking the leap of the middle-aged entrepreneur. And what I mean by middle-aged entrepreneur is somebody who is not graduating college or dropping out of college, but somebody who has 8, 10 plus years of working experience. They have a family, they have responsibilities, and the entrepreneurial journey, unless you have unlimited money, it's a scary thing for a lot of people, right? Leaving a career that you've basically excelled in, leaving a career that you've excelled in to go and find a co-founder and do the whole kind of like marching mechanism of like raising capital and getting friends and family to believe in an idea and building decks and all that stuff. That is it's an extremely scary endeavor, right? And most people never make that leap. And so there are a lot of people that want to be entrepreneurs, but just have never had the option to go be one. And we think that Montauk Climate gives you that platform. And so we do spend a lot of time recruiting. We spend a lot of time speaking to founders. So far, the majority of the founders that we have met have been through basically trying to find consultants to go and help us support the idea and bring the idea from phase 1 to phase 2. And as we think about the consultancy process, they're like, could I run this bit? Is this something I could run, right? I quit my job if I can go run this. And so we've seen a lot of that formation. And so we have a massive database of folks that we are considering as EIRs, entrepreneurs in residence, that have full-time jobs that are just waiting for a platform that they can dig their heels into. But we don't want people to just leave their job and then try something for a couple months and then have to go back into the workforce. That's even scarier. And so I think we spend a lot of time we're highly considerate on thinking about ways to bring people into the entrepreneurial kind of journey. And yeah, we use kind of all of the resources, all the tools in our tool chest to be able to go and find really high quality folks with conviction that want to be entrepreneurs, that need a soft landing. And what I mean by that is they get a meaningful salary. They're not sitting around like other studios or other venture accelerators or incubators like Y Combinator. They give you very small amounts of capital and you have to make it work. We say to ourselves, like, if we don't want our founders to be distracted and have to worry about, putting their kids in school or, the family vacation, right? The goal is to mitigate some of those external factors and let them focus specifically on building businesses. And so far, we've been able to recruit 6 really high quality CEOs. We probably have at least 15 people on the executive teams across the 6 incubations. And so we've got a big group of folks, and those groups also have their networks as well. And so it really is tapping into first-party connections, arm's length folks that we know in the industry, and then just, going through pretty deep explorations on the best subject matter experts that could run with an idea and then growth focused operators that want to get into climate. It's kind of a combination of those three things.
Evan, I wanted to ask you, you mentioned something a little bit earlier on about 10% versus 10xing. And particularly as you're bringing in, these entrepreneurs into there, I mean, how much pressure is there on them to get to that 10x and thinking about that? And how much thought is given to that even in that initial phase when you've got the idea and you're throwing it around? Because there's good idea versus something that you can really take next level. Is that something that you think about in those early stages?
Absolutely. If we, the biggest risk for us is to build something. If we think that we're building something that's a venture scale, we need to make sure that it has venture scalability. The cool part about Montauk Climate, again, is that we don't have to build it for venture scale. If we can generate, positive EBITDA in the first month, we could build it, right? Great. That's not necessarily going to be a business that's going to be global, but if we can generate meaningful impact and make money at the same time, that's not something we're not going to spend an inordinate amount of time on that, because that's not going to be a use of time or return on time capital. But to your point, a lot of the entrepreneurs, they are not thinking about TAM. They're not thinking about addressable serviceable market. They're thinking about, I could build one thing, and I could build one thing really well, and I can let investors know I'm going to be the best at building this one little widget. And investors want to hear how you're going to build the machine that builds the widget. They want to hear how you're going to build the next category killer or the next brand leader. And there's a lot of coaching that we have to do as well with our CEOs around thinking big and thinking about how they scale their platform and how they actually use money. When you tell somebody who's been in enterprise for 20 years that you're going to raise $20 million and you're going to hire 100 people, they're like, wait, I don't need 100 people. Well, if you want to build a scalable business that can scale across multiple categories and multiple geographies, you might need to think about that way. So it's reframing some of the conversation. There's not a lot of pressure early days to go out and say that how we're going to build a 10x business, but we want to reframe most of the discussions is that if we're not going to have 10x impact, it has to have 10x returns, right? So like there has to be a reason for us spending time on these platforms. Otherwise, we don't have that many cycles, right? I think one of the other insights that we decided to focus on investing across multiple categories is we said climate issues are not a 15-year problem. They're a now problem. So we need to be thinking about incubating and starting companies that start growth in 3 years or 4 years rather than waiting 10 or 15 years. And so if we mess up on our time management and we build a bunch of little things here and there, it's not going to actually generate the impact that we're looking for. So reframing the discussion around how can we make this a platform versus a feature is probably where we spend majority of our time. And we're not going to take a platform to market to go and and fund in the venture community unless the addressable market, the total market is in the trillions, right? Otherwise, it's too small, it's too niche. And we've already seen, and Jemma, I'm sure you have as well, a lot of single point solutions in climate that are not platforms, but they're features. And they've all got funded in 2018, 2019, 2020, 2021, and they're all hitting a wall. They're all hitting a gap because they've got one really good customer with one really good product, but that's it. And nobody's going to buy anything else from them. And so we want to reframe most of our CEOs to think about themselves as a platform versus a feature, even if they're building a feature to start. And that's where we are coaching, and we feel like we're adding a lot more value than just being a first investor, right? We are really in the trenches with our CEOs and really in the trenches with our executive teams to reframe the conversation and really build businesses that are built for scale.
Jemma, is that how you're seeing it as well in terms of the changes that are happening in that, the differentiation from the features to something looking at a much bigger scale?
Yeah, I think that the timing piece is really, I think it just as important as actually, what the product is. And, there was a lot of things, it was a lot more capital available back, 2017, 2018. Like capital markets have tightened massively, and that has actually had a lot of companies like run out of cash because they haven't actually got that product right, the product market fit. It's not replicable, it's not scalable. And you're seeing right now in the capital markets, valuation down rounds. So, companies raising money at not just a little bit lower valuation than they were previously, but dramatically. And we actually spoke about that when we chatted earlier this month at Evan. Would you be able to give us, tell the listeners about cramming out and what that is and what you're observing generally with capital markets, which I think feeds into this question around product as well.
Yeah, that's a really good insight there. There's been since the capital markets have really been more constrained and really in this inflationary and more higher interest rate environment, the free money, zero interest rate environment that we all kind of took for granted over the last couple of years has stopped. The IPO market has completely slowed down. We have close to 200 years of IPOs that are unicorns that need to IPO, which is wild, right? I mean, there's just too much money, zero interest rates, borrow, spend. And so what we saw in the 2019, 2020, 2021 was really expensive rounds with lots of capital deployed at very high valuations. And there's a phenomenon that has emerged, and it's always been the case, but maybe it's not been as relevant in venture, around down rounds that are extremely punitive to early investors. And early investors should get a benefit, right? I mean, they're the ones taking the most risk, but because they can't continue as an investor, right? So they're seed funds that can't participate at B, or they're A funds that can't do C, or they're out of capital, they don't have any leverage at that point. Even if they've contracted with preferred returns or a liquidation preference or negative control provisions, they are out of options. And so anyone with capital today that is fresh powder, right? Fresh capital that isn't constrained or burdened by companies' failure to grow has all the power. And what they're doing is they're creating two types of structures. One, a pay-to-play structure, where if you don't contribute at these terms, you get diluted to basically zero. You have no economics left. Like, you take a full loss in the business. The business can be mature. You could have invested in the seed round at a $5 million valuation. It's now a $50 million valuation company. If you don't continue to participate, your investment is worth nothing. And so all of that time, all of the markups, all of the success of the business, you have $0 economics left, or extremely punitive requirements to invest. And at that point, what do you do, right? Do you just let the investment go to zero? These are still going concerned businesses. These businesses still have opportunity and upside. There's new dollars coming into the businesses. And so you have this decision to make. Do you throw good money after bad, or do you decide to just take a loss and move on? And so that is happening across almost outside of like the big AI rounds, the big up rounds that you're seeing, kind of this crazy cycle. In almost every other category where a company needs additional capital and can't access the public capital markets, you're seeing major down rounds. So it's pay to play and cramming, I guess it's this kind of unofficial term, which is really around forcing investors to participate or basically liquidating them to nearly zero and giving them a very small opportunity to put a little bit more money in to try to protect their economics. And these are big investors. This is not happening to angel investors and friends and family investors, which I would say, if you're an angel investor now, you have to be very concerned about the cash needs of a business as it scales and grows. Because if you don't have the ability to continue to participate, it's almost a guarantee that you're lighting that money on fire. And your original thought process was, yes, you will get dilution across the different across the different rounds. And you're okay with getting 50 or 60% dilution because you're stepping up your valuation. But as an angel investor that can't contribute at later stages, the risk profile of that investment, it should be treated as an option, not as an investment. You're investing as an option with theta and vol, and you need to be willing to lose 100% of it, because there is a chance that even if the company is successful, you will not have any economics left. And that is unfortunate, and an unfortunate part of the story right now is the people with fresh capital have the ability to demand terms. And
because the capital markets are so much tighter. And it sounds like what you're saying also, Evan, is it's not just companies that are like in trouble. that it's just because I mean cramming would normally happen when a company's like in real trouble, but I
Yep.
think what you're saying is this is happening in more like normal circumstances as well.
Yeah, so a lot of the companies, especially in our category, and Gemma, I'm sure you have very unique insight, underestimate the lead times for long lead customer acquisition and deployment.
Yeah.
And they are like, oh, we sold to a utility, we're in a pilot, and you're like, great, that'll be revenue this year. Like, no, it's going to take 2 years, 3 years, 4 years, who knows how long. And so a lot of these companies don't raise enough money to sustain themselves through these cycles, right? These procurement cycles. And a lot of the businesses that we focus on need to engage with public, private utilities, municipalities, co-ops, cities, building owners, real estate. These things don't happen at the speed of fintech or blockchain even. They happen in ultra long leads. And so a lot of entrepreneurs and founders are coached to raise to not their, again, this is a very interesting dynamic. You don't want too much dilution, so you raise not enough money, and you raise just enough that can get you to that next procurement cycle, and then you realize you didn't raise enough, and then you have to go raise more, and then you end up in the same place, but you end up in a worse place than you did before because you have to go back to the market with less success. And so you're not raising enough capital at the right times. You're having to wait to raise capital in a situation where you need the money, and then other entrepreneurs and founders raise too much capital at too high of a valuation and overspend and never actually get there. And so these are the dynamics that founders are having to play with, and it's very nuanced. And yes, basically you're seeing companies that are successful, that have product market fit, that have good IP, good technology, a great brand, and are having to raise additional sets of capital at lower rounds and crammed down rounds because they're basically running out of money. These companies don't operate with positive EBITDA margins, at least in the beginning. And so it's been pretty challenging. It's one of the reasons why timing is everything, as you know, Gemma. And if you had a vintage round in 2021 or 2022, those deals are massively marked down. I mean, the return profile for venture during those years there's a major differentiation now between the successful funds and everyone else. All those other funds are writing off their investments at this point. And so one of the reasons why we think now is a great time is we think valuations have come down, capital markets are constrained, entrepreneurs are more aware of needs, and you're getting much better deals. You understand the mechanics of long lead sales cycles, selling to utilities, etc. And so the planning is just in a better place and lessons learned than it was a couple of years ago. And so that's one of the reasons why, as Montauk, we started as incubators and at the venture studio, because we don't have any of that legacy overhang. We don't have technical debt. We didn't raise money at down rounds and dealing with founder issues. So we felt like the 0 to 1 and the earliest stage approaches were going to be the best. And then we said, okay, well, the capital markets are very tight. Series A and Series B valuations have come way down, and they're becoming much more pragmatic and practical platforms. And so now is also a great time to invest early. I'm still worried about growth. I'm still worried about later stage Series C, Series D, until we see a little bit more freeing up of the capital markets and maybe a little bit more M&A activity, which should come from slightly lower rates in the US. I'm still a little bit worried about that growth period, but we've got plenty of time, right? The Series A and Series B folks have, 18, 24, 30 months of runway, hopefully, to get there. So yeah, that's a quick kind of pulse on how the market is operating right now.
I mean, what you're really saying is that, in this new category around kind of, fintech related to energy, the enterprise sales cycles are long, and you really need to understand that properly, as you do in thinking about like the businesses that you're creating, and also how you're going to invest such that you protect yourself in further rounds as well.
Yes. And so how do you protect yourself early is structuring deals that have liquidation preferences, negative control provisions, and governance. And a lot of early investors don't do governance. They don't want to be on the board. They don't want to know what's going on. They just want to be told at the end of the year that there's a markup. I think if you want governance, you have to be active. Like, you have to have time. You can't just be a venture investor that's in Mykonos in the summer and traveling around in the winter and whatever else. Like, if you're going to write a big enough check, you should have commensurate governance so that you can actually protect your interests. Otherwise, there's a very high risk that if things don't go well, that becomes an option rather than an investment, right? It becomes a trade and an option versus a longer term hold. that being said, not everyone can be dealing with governance, especially if you're a high velocity shop doing a lot of investments. And so the opportunity there is to pair yourself with a venture investor that wants governance, and you're kind of like that, they're your surrogate, right? Like they are acting with your interest in mind. And so that is a helpful way to kind of think about partnering with larger funds that can protect you because you are a value add investor. And so not every big shop has value add investment, right? They could have a lot of capital, they could have a lot of connectivity, but ones with subject matter expertise are not also the ones running the largest funds. And so there's ways to kind of think about protecting yourself through partnerships, through just more alignment of interests, and really kind of nailing down early governance early, and just making sure that you're not doing that company has enough capital that you don't end up in that position. And so a lot of times, like, entrepreneurs will call us up in previous investments. They're like, oh, we ran out of money. Like, did you not know that 8 months ago? Like, how did you run out of money? Shouldn't you have that conversation with someone 8 months ago? And like, a lot of folks don't want to make those hard decisions, like letting people go, because it feels like you're going the opposite direction. And so all of this is to say that entrepreneurs need help. Early stage companies are fun to build, but have a lot of risk. And if we can figure out better ways to manage that risk, we feel like we have better opportunities to create, more meaningful outcomes and avoid the pitfalls of a traditional solo entrepreneur journey, or over raising capital or not raising enough capital. It's really about being very thoughtful around how you raise, when you raise, how you spend, what markets you're going after, and being optimistic, and being, your biggest cheerleader, but also at the same time, being pragmatic and practical. And I think that's where a lot of these businesses miss. But, some would argue that the biggest swings took the most risks, and you need to have the zeros in order to have the 1,000Xers. And so anyway, there's probably two sides to that coin there.
Yeah, absolutely. I mean, you mentioned timing is everything. We're a week away from the US election. Depending on the outcome, like, is that what the outcome either way going to impact your portfolio companies from the studio?
Yeah, I think the U.S. market is extremely interesting because we obviously have our federal government and we have our state governments. A lot of the decarbonization initiatives have been state-led. Obviously, the federal government, you don't fight the Fed ever. And so, like, if you fight the Fed, you'll lose. So just go with what the Fed is doing. But a lot of the decarbonization programs were developed in California during more Republican-dominated markets, like with Republican president, Republican House, Republican Senate, et cetera. We have like this bipartisan system here in the U.S. The states have rights, federal has rights. If we end up with the same administration that we have now, which again, I don't know, the betting markets say Trump's going to win. The polling markets say it's pretty close. But if we end up with the same administration, the policies that we've had for the last 4 years are going to continue, which is around decarbonization, which is around, national security and shoring up the U.S. kind of domestic supply of energy, the tax concept. Hopefully inflation calms down a little bit. So like the status quo seems like we're going to have the same platforms and things that we're focusing on are going to continue to grow. If the administration changes, president changes, but we still have a divided Senate and House, it's kind of the same. Like we're not really, I don't think very many people are extremely worried about fundamental shift. Like we're going to go back to burning oil and whaling, like we're not going to be killing whales. Like if the administration shifts so we can burn whale oil, I think there will be some changes on the federal side. I think the biggest thing for the U.S. is the interest rates, right? If we can get SOFR down to a nominal level, like sub 4% into 3 handle, the capital markets will open up, the lending markets will open up, the economics of a lot of these things will become more economic, right? I mean, the capital markets, the economics, but at the same time, like we still have aging infrastructure. We still have in the U.S. legacy power assets that are retiring. We still have a data center growth and explosion of new load. And so like there's fundamental things that are happening that the administration can either try to slow down or speed up. But like on one side, you have the Trump administration that wants to remove regulation from everything. And so it could be like a wild west of new generation and new load. You have the Biden administration and the Harris administration focusing on increasing regulation and making things go green, but that doesn't necessarily mean they're going to go green faster. And so there's I think there's a silver lining in both outside of people's like political lean. I think I can't control who wins the presidency, other than vote. But at the same time, like we have to be able to navigate the waters, whichever direction they're flowing in. But I think in either case, the cat's out of the bag, the genie's out of the bottle in all of the things that we're focusing on, right? Climate risk, infrastructure, energy transition, sustainability, circular economy, reducing pollution. I mean, all of those things seem obvious. And again, it's a question of where's going to be the biggest kind of bet that's made. But I think that either way, we're going to be in a really good spot to be able to support additional investments. It's just going to come from different angles.
Yeah, I mean, because the way you've created the companies, also with tighter capital markets and the insights of like think big, but also how to grow the companies sensibly with like not just feature sets, but actual platforms that with, good possibility of product market fit. The quote, like hard times create strong men and strong men create good times. And good times create weak men and weak men create hard times. I think that's kind of like, 2019 to 2021 was like, easy money and like crazy spending and not really good thought around product. And I think, it sounds like regardless of what happens election wise and also interest rate wise, you're well positioned to take advantage of those because you've got the fundamentals like sound.
I think so. Yeah, I think that makes a lot of sense. Yeah, times are tough now. Tough. I mean, everyone's still, we're tough, relatively tough. I want to just maintain that. It's not been an easy time to raise capital. It's not been an easy time to form funds. I think that it makes us a lot more, and it really requires us to sharpen our pencils and to be a lot smarter about how we think about building companies, deploying businesses, developing platforms. All of that it's requiring us to be a lot smarter about how we think about the next 5 or 10 years. Whereas again, you're right. When money was free and easy, everything got funded, and you see where those businesses are today, right? That it's literally lit money on fire and evaporated capital and wasted a lot of time. And so, yeah, I think we're in a good spot. I think generally speaking, you can either have the view of big swings and like money's available and free and like, let's just go do crazy stuff. Or you could be in the camp that you're going to like, hit singles and doubles and sometimes some grand slams and sometimes knock it out of the park. And I think it's a question of when times are tough, I think the kind of batten down the hatches and do the things that you need to do, you'll have more longevity in this market than someone who's just kind of like throwing money around and spraying and praying and wishing that they're, really requiring that luck is the only thing that works. Right. And again, there are plenty of lucky people out there. So,
yeah, I mean, fate could happen, but I think you're being much more deliberate around that to bring it on in a more certain way. Just before I round up, Evan, could you tell us your favorite song at the moment and your favorite podcast?
Oh, wow. Okay. Well, podcasts, haven't been listening to very many podcasts recently. I got to pull up my Spotify here. 1 second.
Go ahead.
See what I've got here. Yeah, I'm working all the time. I don't even listen to music. So I operate at like a high level of stress. And there's a track on Spotify called Weightless, which is like clinically proven to reduce stress levels the second you listen to it. And I have it on an 8-hour loop. And so it's called Weightless, the Macroni Union. And it's somehow I stumbled upon this thing and it just puts you into like a immediate calm. And so that's the one that I'm listening to all the time. So that's my song. And then I haven't listened to any podcasts. I want to make podcasts. Yeah.
But cool. You can have a no podcast list. Thank you so much, Evan. I've really enjoyed the conversation with you. My takeaways from this chat are around really doing the work to build conviction in a concept. And you use the word glutton for punishment, which I think you see as a way for getting unique insights that have you be able to build businesses, and not just one. I think variety is really important to you and growth is really important to you. And so sponsoring many entrepreneurs allow you to have all that variety and also make a big impact. And it's not just a 10% thing, as you said, it's 10xing. And I like that it could be 10% impact or 10% returns. And then thanks also for telling us all about cramming today. and the kind of holy trinity between ideas, people, and capital, and that those things really need to coalesce together to really spearhead a new company, a new idea that could really be game-changing and world-changing. And I think, as you said in final, the world is about momentum, feelings and vibes, and I couldn't agree more. And thank you so much.
Awesome. Thank you.
That's all for this episode of UnBlock'd. Please check out the show notes for information on Power Ledger and other contact information. We welcome your comments and feedback, and please hit subscribe wherever you are listening. This podcast was produced by Podcasts Done For You. We look forward to your company next time on UnBlock'd.